Have you ever stopped to think about how this stuff just sitting in a warehouse can completely change a company's profits on paper? It's kind of wild, right? Well, that is the power of inventory accounting. And trust me, it's not just about counting boxes, it's about the strategic journey of a single cost. And today, we're going to follow that journey from the very beginning to the very end.
So here's our game plan. We're going to track a cost as it literally travels through a company's books. We'll see how it starts as an asset and then turns into this powerful expense that hits the financial statements. We'll explore the different paths it can take, the huge impact of those choices, and of course, what happens when the whole journey goes off the rails.
Okay, so let's start with a really basic question, just to reframe how we're thinking about this. When I say inventory, you probably picture a warehouse, right? Shelves stacked high with products. And look, you're not wrong, but for our purposes, that's only half the story. See, the real concept, the thing we're actually tracking, is the journey of a cost. Think of it like this. When a company buys inventory, that cost just sits on its balance sheet. It's an asset, something valuable the company owns. But the second that item is sold, its cost has to pack its bags and move over to the income statement. It becomes an expense called cost of goods sold. So the entire game of inventory accounting is deciding exactly when to make that move. And as you're about to see, that timing, it's everything. All right, let's dive in. This journey begins in one of two very different worlds. And believe me, the path a cost takes is completely different depending on which world it's born into. On one side, you've got your merchandising businesses. Think Best Buy. It's pretty straightforward. They buy finished goods and they sell those finished goods. Simple. They have one inventory account, merchandise inventory. But then, on the other side, you've got a manufacturing business, like Ford. They buy raw materials and actually transform them into something new. That complexity means their inventory costs live in three totally separate accounts.
So for a manufacturer, a cost starts its life as raw materials. The steel, the rubber, the glass. As those materials get used on the factory floor and you add in labor and other factory costs, all those costs move into a new bucket, work in process. And finally, when that car rolls off the assembly line, all those accumulated costs get transferred one last time to finished goods. Now, and only now, is it ready to be sold.
Okay, so we know where these costs live. But now we get to a huge fork in the road. When a company sells, let's say, one car, which specific cost do they move to the income statement? This gets really tricky when they've bought identical items at different prices over time.
This decision is what we call a cost flow assumption. And listen up, because if you take one thing away from this section, let it be this. This is purely an accounting choice. It does not have to match how the actual boxes are physically being moved around the warehouse. An accountant can assume the first box bought was the first one sold, even if a forklift driver just grabbed the newest one right off the top of the pile. The two main paths, the two big players here, are FIFO and LIFO. First in, first out, or FIFO, assumes you sold the oldest stuff in your inventory. Makes sense. But last in, first out, LIFO, assumes the exact opposite. You sold the most recent items you purchased. As we're about to see, this simple, on-paper choice has absolutely massive financial consequences.
All right, enough theory. Let's get our hands dirty with some numbers and see how this actually plays out. This is where you can really see the strategic power hiding behind this simple accounting choice.
So here's our scenario for Company A. Take a look at the purchase price per unit. Notice how throughout May it's constantly going up, from 10 pesos at the beginning of the month all the way to 15 pesos by the end. This kind of inflationary environment is exactly where the FIFO versus LIFO decision becomes so incredibly important. Okay, so let's go with the FIFO method first. We assume the first units we sold were the first ones we bought. Simple enough. So our cost of goods sold gets calculated using those older, cheaper prices from the start of the month. That gives us a COGS of 11,000 pesos.
But now, let's flip the script and look at LIFO. Here, we assume the first units we sold were the last ones we bought. We match the sale against our newest, most expensive inventory. And look at the difference. This pushes our cost of goods sold way up to 13,600 pesos.
And this right here perfectly illustrates the strategic why. Why on earth would a company want a higher cost of goods sold? Well, a higher COGS leads to a lower gross profit and ultimately a lower net income. And why would you want lower profits? It's simple. Lower profits mean a lower tax bill. In times of rising prices, LIFO is an incredibly powerful tax deferral strategy. So far, the journey of our cost has been pretty smooth. But what happens when things go wrong? What if inventory gets damaged?
or a new model comes out and makes the old one obsolete, or market prices just collapse. What happens when your asset suddenly loses its value? Well, accountants have a rule for this, and it's all driven by a principle called conservatism. It's the lower of cost or net realizable value rule. NRV is basically what you think you can get for an item when you sell it, minus any costs to finish it and get it sold. If that NRV number is lower than what you originally paid for the inventory, you have to write down its value and recognize a loss right away. No waiting.
Now, this is really interesting. This is where we see a huge split between International Accounting Standards, IFRS, and US standards, GAAP. Under IFRS, if that inventory's value bounces back later, you can actually reverse the write-down. But under US GAAP, no way. That reversal is strictly forbidden. Once you write it down, that new lower value is its permanent cost, period. It's a much more conservative approach, and it's designed to stop companies from playing games with their profits by writing inventory down one quarter and then back up the next.
All right, for our last section, let's look at what happens when this whole journey goes completely off track because of a simple counting mistake. The ripple effects are just enormous. Here's the wild thing about an inventory error. It has this strange counterbalancing effect. If you understate your ending inventory in year one, your cost of goods sold for that year is too high, which makes your net income too low. Bummer. But here's the twist. Because year one's ending inventory becomes year two's beginning inventory, the error automatically reverses itself in the next year. Year two's COGS will be too low, and its net income will be too high by the exact same amount.
So here's the real kicker. Even though the error washes out of the income statement over 2 years, it leaves behind a trail of completely misleading data. For 2 full years, it messes up the key financial ratios that analysts, bankers, and investors rely on. It can make a company's ability to pay its bills look worse than it is, while making it seem deceptively efficient at selling its products. These are the numbers that drive real-world decisions, and for 2 years, they're just plain wrong.
This quote really brings it all home, doesn't it? It gets us back to that central theme. Inventory is not just a static number on a page or a pile of boxes in a warehouse. It is a constant, dynamic flow of costs moving from an asset to an expense. And managing that flow correctly, well, that's one of the most important jobs in all of financial reporting.
And that brings us to you, because as you move into your careers, you're going to be the one making these calls. If you're faced with rising prices, what do you do? Do you choose FIFO to report higher profits and impress investors? Or do you choose LIFO to minimize the company's tax bill and boost its cash flow? The path you choose will tell a very, very different story about your company.